Welcome to your journey toward financial literacy mastery. In this video, we'll break down everything you need to know about money, markets, and wealth. Whether you're just starting out or aiming to sharpen your skills, these notes will guide you from basic concepts to advanced strategies. We'll cover real-life examples, practical frameworks, and actionable steps so you can confidently manage your finances. Let's begin by understanding why financial literacy is essential for everyone, regardless of age or income. With the right knowledge, you can make smarter decisions, avoid common pitfalls, and build lasting wealth. Ready to unlock your financial potential? Let's dive in. Before you invest or save, you need to speak the language of money fluently. This foundation is crucial for understanding every other financial concept. We'll start with basic terms like income, expenses, net worth, and inflation. These are the building blocks of your financial vocabulary. By mastering these, you'll be able to track your progress, identify opportunities, and spot risks early. Think of this as learning the grammar of finance. Once you know it, you can construct your own financial story. Let's explore how money flows in and out of your life and why managing both sides is equally important. Money flows in two directions, into your life as income and out as expenses. The gap between these two is what you have to work with. Most people focus on earning more, but managing what flows out is just as powerful. Net income is what remains after taxes and deductions. It's the real money you can use. For example, Rahul earns a gross salary, but after taxes and deductions, his net income is much less. By tracking his expenses, he found unused subscriptions and freed up capital for investment. This simple habit can make a big difference in your financial journey. Budget isn't a restriction, it's a plan for your money. Without a plan, money can disappear into an invisible void. There are several popular budgeting frameworks, such as the 50-30-20 rule, zero-based budgeting, pay yourself first, and the envelope method. Each framework suits different personalities and spending habits. For beginners, the 50-30-20 rule is simple: 50% for needs, 30% for wants, and 20% for saving. If saving 20% feels impossible, start with just 1% and increase gradually. Automation is key. Set up standing instructions so your savings happen before you spend. Your net worth is the single most important financial number. It tells you where you actually stand. Net worth is calculated as total assets minus total liabilities. High income with high debt can mean a negative net worth, a trap many professionals fall into. Assets include cash, investments, and physical items like cars or jewelry. Liabilities are debts like loans and credit card dues. Tracking your net worth helps you set goals and measure progress. For example, Priya calculated her assets and liabilities, set a target, and planned to grow her investments while paying down debt. Inflation is the rate at which prices rise over time, eroding the purchasing power of money. If your money sits in a low-interest savings account, it's actually losing value. For example, a cup of coffee that cost 5 units in 2004 now costs 30-40 units, a 6-8x increase. Investments must beat inflation to preserve wealth. The Sensex has returned about 14% annually over 20 years, giving a real return of 8-9% after inflation. Understanding inflation helps you make smarter investment choices and protect your wealth from being silently destroyed. Rule of 72 is a practical tool to estimate how fast your money grows. Simply divide 72 by the annual return percentage to find the years needed to double your money. For example, a savings account at 3.5% takes about 20 years to double, while a small cap equity fund at 16% doubles in just 4.5 years. This rule helps you compare investment options and set realistic expectations for growth. Understanding this concept empowers you to make better choices and plan for your financial future. Banking is the foundation of your financial life. Banks take deposits and lend money at higher rates, earning profits from the difference. Understanding how banks make money helps you see why credit card debt is so dangerous. For example, banks pay low interest on savings but charge much higher rates on loans and credit cards. This spread funds their operations and profits. Knowing this, you can avoid costly debt and use banking products wisely to grow your wealth. Interest can be simple or compound. Simple interest is calculated on the principal only, while compound interest grows on both principal and accumulated interest. Over time, compounding can make a huge difference. For example, investing one lock at 8% for 10 years earns $80,000 in simple interest, but over 2 lock with compounding. The key to harnessing compounding is time. Starting early multiplies your wealth. Even Einstein allegedly called compound interest the eighth wonder of the world. A credit score is a 3-digit number that represents your creditworthiness. In India, a score above 750 is considered good. Lenders use this score to decide whether to lend you money and at what interest rate. Factors affecting your score include payment history, credit utilization, length of credit history, credit mix, and new inquiries. Maintaining a high score means paying bills on time, keeping credit usage low, and avoiding multiple loan applications. Good credit score opens doors to better financial products and lower interest rates. Credit cards can be useful, but they come with risks. Minimum payments are designed to keep you in debt. If you owe $50,000 on a card charging 42% annual interest and pay only the minimum, you'll take over 15 years to pay it off and pay 3 times the original amount in interest. Always pay the full outstanding amount every month to avoid falling into the credit card trap. Understanding this can save you years of financial stress and thousands in unnecessary interest. Stock represents fractional ownership in a company. When you buy shares, you profit when the company grows and share losses when it struggles. Companies raise capital through IPOs, and shares trade on stock exchanges where buyers and sellers determine the price. For example, LIC's IPO allowed millions to own a piece of the company, and its price fluctuates daily based on demand and supply. Understanding stocks helps you participate in business growth and wealth creation. Market indices track the performance of selected groups of stocks. Examples include Sensex, Nifty 50, Nifty 500, S&P 500, and Dow Jones. Each index represents a segment of the market, helping investors gauge overall trends. For instance, Sensex tracked the top 30 companies on BSE, while Nifty 50 covers the largest 50 on NSE. Knowing how indices work helps you benchmark your portfolio and understand market movement. Fundamental analysis evaluates a company's intrinsic value by studying financials, management, and industry position. Key ratios include PE, PB, ROE, debt equity, and EPS growth. Comparing these ratios helps you decide if a company is worth investing in. For example, TCS commands a premium valuation due to superior return ratios, while Wipro is cheaper but grows slower. Fundamental analysis guides long-term investment decisions based on real business performance. Technical analysis studies past price and volume patterns to predict future movements. Tools include support and resistance levels, moving averages, RSI, and volume trends. For example, a support level acts as a floor while resistance is a ceiling. Moving averages signal trends and RSI indicates overbought or oversold conditions. Technical analysis is especially useful for short-term trading decisions, helping you time entry and exit point. Markets move in cycles, bull and bear phases. Emotional reactions can lead to poor decisions like panic selling during crashes. For example, the 2020 COVID crash saw Nifty 50 drop sharply, but those who stayed invested or bought more saw massive gains during the recovery. Understanding market cycles helps you stay calm, avoid emotional mistakes, and focus on long-term wealth creation. Mutual funds and ETFs allow ordinary investors to own a diversified basket of securities managed by professionals. Mutual funds are priced at NAV, calculated daily, while ETFs trade like shares throughout market hours. These vehicles simplify investing, reduce risk, and make it accessible for everyone. Choosing the right fund or ETF depends on your goals, risk tolerance, and investment horizon. Mutual funds come in many types: equity, debt, hybrid, and index funds. Each has different risk and return profiles. Equity funds offer higher returns but more risk, while debt funds are safer with moderate returns. Hybrid funds balance both. Index funds track market indices passively. Choosing the right type depends on your timeline and risk appetite. For example, small cap funds are best for long-term goals, while liquid funds suit short-term needs. It means investing a fixed amount in a mutual fund at regular intervals. It harnesses repeat cost averaging, buying more units when prices are low and fewer when high. This smooths out market volatility and builds wealth over time. For example, investing $10,000 per month in a Nifty 50 index fund over 10 years can double your corpus, even through market ups and downs. SIPs are ideal for beginners and long-term investors. ETFs are like mutual funds but trade on stock exchanges like shares. They typically track an index passively and have lower expense ratios. ETFs are best for cost-conscious and active investors. You can buy or sell ETF units throughout market hours, making them flexible and efficient. Comparing mutual funds and ETFs helps you choose the right vehicle for your investment style. Every mutual fund has two versions, regular and direct. Regular plans are sold through intermediaries and have higher expense ratios. Direct plans are bought directly from the fund house, saving you 0.51% annually. Over decades, this difference can add up to locks and extra returns. Always choose direct plans for long-term investing to maximize your wealth. Bonds are loans you give to governments or corporations. In return, you receive regular interest payments and your principal back at maturity. Bonds form the conservative pillar of any diversified portfolio. Understanding bond fundamentals, face value, coupon rate, maturity yield, and YTM helps you choose the right bonds for your needs. Bonds are ideal for risk-averse investors seeking steady income. Bond prices and yields move inversely. When interest rates rise, bond prices fall. When rates fall, bond prices rise. This relationship is crucial for understanding bond investments. For example, when RBI raised rates, long-duration bond funds lost value but new bonds became more attractive. Knowing this helps you manage risk and optimize returns in changing market conditions. There are several types of bonds: government securities, GSEC, state development loans, SDL, PSU bonds, corporate bonds, tax-free bonds, and RBI floating rate bonds. Each type has different risk and return profiles. Government bonds are safest, while corporate bonds offer higher yields but more risk. Tax-free bonds provide interest income without tax. Choosing the right bond depends on your risk tolerance and income need. Tax is one of the largest costs in investing. Understanding how your investments are taxed and legitimate ways to minimize tax is a core financial literacy skill. Capital gains tax varies by asset class and holding period. Smart investors use strategies like tax harvesting to save thousands annually. Knowing the rules helps you keep more of what you earn and grow your wealth faster. Capital gains tax applies when you sell assets like stocks, mutual funds, real estate, or gold. The rate depends on the holding period, short-term or long-term. For example, equity held over 12 months qualifies for long-term capital gains, which may be taxed at a lower rate. Smart investors use the annual exemption to harvest gains tax-free. Understanding capital gains tax helps you plan sales and maximize after-tax return. Section 80C allows you to deduct up to 1.5 lakh from taxable income by investing in eligible products like ELSF mutual funds, EPF, PPF, NSC life insurance, and home loan principal repayment. This deduction reduces your tax bill and encourages long-term savings. For example, investing in ELSS not only saves tax but also grows your money at market rates. Using Section 80C wisely can boost your returns and financial security. Money without a plan is like a ship without a compass. Personal finance planning connects your money to your life goals, retirement, children's education, home purchase, travel, and creates a roadmap to reach them. Setting clear goals, timelines, and investment strategies ensures you stay on track and make progress toward your dreams. Planning is the key to turning income into lasting wealth. Emergency fund is a non-negotiable foundation. It's 3-6 months of expenses kept in a liquid, safe vehicle like a savings account or liquid mutual fund. This fund protects you from taking on debt during crises such as job loss or medical emergencies. For example, Vikram's emergency fund allowed him to navigate a job loss stress-free. Building your emergency fund is the first step in financial security. Insurance is not an investment, it's risk transfer. You pay a small premium to transfer a large potential financial loss to an insurer. Types include term life, health, critical illness, and personal accident insurance. The rule of thumb is to cover 15-20x your annual income for life insurance and at least 10 lakh for health insurance. Avoid mixing insurance and investment. Proper insurance protects your plan and your family. Goal-based investing matches your investment choices to your life goals and timelines. For short-term goals like vacations or car purchases, use safe instruments like recurring deposits or short-duration debt funds. For long-term goals like retirement or children's education, use equity mutual funds and real estate. This framework ensures your money grows appropriately and is available when you need it. Behavioral finance studies how emotions and cognitive biases affect financial decisions. Loss aversion, confirmation bias, recency bias, herd mentality, and overconfidence can systematically destroy wealth. Recognizing these biases is the first step to overcoming them. For example, panic selling during market crashes locks in losses, while following the crowd can lead to buying at market peaks. Awareness helps you make rational decisions. Loss aversion means losses hurt about twice as much as equivalent gains feel good. Investors often hold loss-making stocks hoping to break even while selling winners too early. For example, those who panic sold during the 2020 crash locked in losses while patient investors recovered fully. Understanding loss aversion helps you stay invested and avoid emotional mistakes. Confirmation bias is seeking information that confirms your beliefs and ignoring contradictory data. For example, investors bullish on certain stocks may dismiss negative reports and only read positive news, leading to poor decisions. Recognizing confirmation bias helps you stay objective and make balanced investment choices. Recency bias means overweighting recent events and assuming current trends will continue forever. For example, after a strong market rally, investors may expect endless gains and invest at peak valuations, only to face corrections. Being aware of recency bias helps you avoid chasing trends and make more grounded decisions. Herd mentality is following the crowd rather than independent analysis. For example, during the cryptocurrency boom, many bought near the top, only to see prices crash. Herd mentality creates bubbles and can lead to significant losses. Independent thinking and research are essential for successful investing. Overconfidence bias is believing you have more skill or information than you actually do. Most active traders underperform the index over time, yet many believe they are above average. Passive investing often beats human stock pickers. Recognizing overconfidence helps you stay humble and make better decisions. Anchoring is over-relying on the first piece of information received. For example, investors who bought IPOs at high prices may refuse to sell at lower prices, waiting to break even, which can lead to further losses. Recognizing anchoring helps you make decisions based on current realities, not past prices. Antidote to behavioral biases is a written investment policy statement, IPS. This document outlines your goals, asset allocation, rebalancing rules, and conditions for changing strategy. Refer to your IPS during market crashes or surges to stay disciplined. Legendary investors use this approach to stay consistent and avoid emotional mistakes. Asset allocation means dividing your portfolio among different asset classes to balance risk and return. Studies show asset allocation determines about 90% of portfolio returns, not individual stock selection. Diversification is the only free lunch in investing. For example, combining equity, debt, gold, and real estate reduces risk and smooths returns. Modern portfolio theory guides you to build a balanced, resilient portfolio. Derivatives are financial instruments whose value is derived from an underlying asset. They are used for hedging or speculation. Types include futures, call options, and put options. Derivatives carry very high risk and can amplify losses or gains. SEBI data shows most retail traders lose money in F&O use derivatives only for hedging, not speculation. Real estate and financial assets have different characteristics. Real estate is less liquid, requires large investments, and offers moderate returns. Equity mutual funds are more liquid, require smaller amounts, and offer higher returns. Rental yields are low compared to dividends and capital appreciation from financial assets. Understanding these differences helps you choose the right mix for your portfolio. REITs are listed companies that own income-generating real estate. Investors can buy REIT units on stock exchanges for small amounts. REITs distribute most of their cash flow as dividends, providing regular income. For example, Embassy Office Parks REIT allows retail investors to own premium office space and earn dividends. REITs offer real estate exposure without the headaches of direct ownership. Sovereign gold bonds (SGB) are government bonds denominated in grams of gold. They offer 2.5% annual interest, capital appreciation linked to gold price, and zero capital gains tax if held to maturity. SGBs are superior to physical gold or gold ETFs for long-term holders. Adding gold to your portfolio diversifies risk and protects against inflation. Knowledge without action is useless. Here, your step-by-step roadmap: clear toxic debt, build an emergency fund, get basic insurance, maximize tax deductions, invest for long-term goals, and diversify with gold and debt. Adjust amounts to your income. The sequence matters more than the size. Review your plan annually and adjust for life changes. Wealth is built over decades, not days. Start now and apply these principles consistently for lasting financial success.